Hey guys, John with TRD Trader here. So I got a 2 for video for you today. I'm going to go over the calls I made last week, the calls I'm going to make for next week. I got 2 tidbits I want to share and 1 resource. The tidbits are, as you might know, I focus on newer company, high, future cash flow, not earning money immediately stocks. They're kind of trader stocks. They go up and down pretty quickly. They're highly volatile. And they've also been going lower than I expected. They've been, breaking through my floors, and I've been getting forced into the exercise puts. That's not a problem for me because, I'll just hold on to the stock and sell calls until the stock goes back up. It does kind of suck because I go from earning 2 to 3% of premium selling puts to maybe 0.5% or less selling calls. So that's a risk you need to be mindful of when doing these plays. If you don't want to get stuck with stock, it's better to stay away from the 2 to 3% puts and maybe do a 0.5 to 1% put. That'll give you a lot more breathing room between, where the stock is and where it lands. And you'll be exposed to a lot less risk of getting forced to buy the stock. Or another thing you can do is wait till later in the week. You can wait till Wednesday or Thursday and see where kind of the stock is, and you can maybe chase a 1% return by, looking at what the put options in are midweek. But that's just something to be mindful of, that, I haven't been quite calling the floors right, and I've been getting exercised in my positions. And additionally, in the coming weeks, the Fed is going to release new inflation numbers. If there's higher than expected inflation, that's going to eat away at these stock values because a lot of their valuation is based on discounted future cash flows. The more inflation there is in the future, the less those discounted cash flows are worth in the present, the less the value of the stock is, the greater it's going to fall in the market. So be mindful of that. Another thing you need to be mindful of, this is the other tidbit. We're in August, about to be in September. We're basically going into Q3. In Q3, there's historically, maybe, half the percent of the time, half the time, there's a stock market retracement. The stock goes down in Q3. You can see in 2019, there was it fell just in the beginning of 2018, just after Q3, in Q1 of 2018, so February, January. But here in 2019, it fell in September, and then here in 2020, it fell in August. So be mindful of the fact that, we just had a gangbusters market growth in the last coming months, that we might be due for a correction or a retracement, especially in Q3. So have that in mind when considering some of my plays. Now let's get into the plays I did last week. So here's the plays I did last week, July 6th to July 9th. You'll see that I had a various stocks, ASO, Blink, Fubo, Marathon, MVIS, Riot, Workhorse, that had various, rates of probability of success. And this is the other point I want to go over. That is not something that I make up. This is just something I calculate from this third-party website. You can get it from optionscalculator.com. So there's these, they have various rates of success. I was chasing the 2 to 3% returns, and the floors were falling a lot further than I expected them to. So I got forced into puts, and I'm having to sell calls until the stock goes back up, or I can put more money in. But so you can see the vast majority of them got exercised. Some didn't. Let's look at the ones that expired. So these puts expired, which means the stock price ended up being higher than our spot price. And so they didn't get exercised because no one would want to force you to buy stock for less than what they can sell it for in the market. So for example, we sold this option. If you got in on this option, you would have sold a put for $28. The option expired with the stock price at $28.83. No one would sell a $28.83 stock for $28. They wouldn't force you to buy for $28. So that's an option that you sold that expired out of the money. When an option expires out of the money, you get to keep the money straight in your pocket. So these are 4 options that expired out of the money that I called last week. They were a Fubo, an MVIS, and a Workhorse. They expired out of the money, so you get to keep your premium. If you chose any of the other options, they expired in the money. Unfortunately, our basis in the stock was high enough that you couldn't immediately sell it. What I mean by basis is, So for example, for this Blink, I called a strike price of $36.50, so you got forced to buy the stock at $36.50. You earned a premium of 82 cents, so your basis is the $36.50 minus the 82. Your basis is $35.68. The $35.68 is greater than what you can sell it for. So if you were to immediately turn around and sell the stock, you would have lost 28 cents. And so because you'd be losing money, what you want to do when you're in my boat, you get forced to sell. You get forced to buy stock. The puts are exercised. You turn around and sell calls. So for these stocks, your basis was, $36.68, $35.68, $35.99, $28.25, $28.52, $33.29, $33.93. What you would want to do, you'd want to turn around and sell calls. A call for a strike price of 36, a call for a strike price of 36, 28.50, 29, 33.50, 34. You'd earn premiums of 97 cents, $1, 80 cents, 126, 109. Your ROIs would be anywhere from 2% to 4%. So you'd want to just sell calls until you can get out of the position with the profit. So as you can see, as I said, I didn't quite call the floors right. They've been going further down than I expected. I've been chasing a 2 to 3% return. So if you want to be more conservative than me, maybe you should chase a 0.5% to 1% return, which is probably what I'm going to do with money that I put in the market in the coming weeks. Here's my calls for the upcoming week, July 12th to July 16th. Actually, let me unfilter this. So this week I was a lot more conservative with my calls because I noticed it was an ongoing trend that these stocks were falling further than I expected. I think we're closer to the floor, but I'd still like to be, learning. I'd like to be a little more conservative. So as you can see, these rates of these percentage of profitability are much higher because I'm choosing lower rate of return options. Before it was, in the 60s and 70s. There's only one or two in the 80s. And now it's mostly in the 80s with one or two in the 90s. And once again, we have Blink, Fubo, Marathon, MVIS, Riot, Workhorse. Blink is a EV charging company. Fubo is streaming. Marathon is a cryptocurrency company. MVIS is like infrared, sonar, stuff for automation and driverless cars. Riot is another cryptocurrency company. Workhorse is an EV truck company. And so you can see that the chance of profitability calc, it's showing a lot higher rates. I have strike prices from 33, 34, 25, 24, 13, 14, 29, 30, 10. You can see, as I said, the rate of returns are much lower, but it might be better to earn 0.5% to 1% premium earning puts rather than get forced into stock and only earn 0.5% to 0.25% selling calls. So that's the play that's gonna be the play going forward for the next couple weeks, is probably earning 1 or 1.5% return on puts for myself for any money I can get in the market. You can see I am calling anywhere from 1% return to 3% return. So there's no more of the 4%, 5% return. It's more of the 1% per week. These are my calls for the upcoming week. So as I said, I got exercise into a lot of positions. I'm forced to sell calls, but if I had money, these are the options I'd be looking at. I hope you guys learned something. If not, let me know, comment below. I can expound upon anything or try to explain things better. I hope you guys are in the market and making money. I hope you're just not letting your money sit in a savings account earning 0.25% a year, because you can easily get 0.25% return a week doing what I'm doing here. And so yeah, that's the end of the video. Thank you guys for tuning in. I hope you like it. Like, subscribe. Have a great night, guys.